Okay, let's unpack this one. Today we're diving deep into Oracle Corporation, ticker ORCL. This is a company that's been making some serious waves lately. Lots of discussion,
Hmm.
especially after their latest results and this big push into AI. So for you, our listener, we've gathered, well, all the key details from the reports, analyst takes, strategic stuff, just trying to give you a clear picture of where this tech giant stands right now.
Absolutely. And we're going to sift through, the numbers, the story they're telling, to really understand why Oracle is being called this go-to place for AI workloads. And more importantly, what does that actually mean for their financials going forward? Our goal here really is to pull out the most crucial bits of info so you're properly informed on Oracle's situation and its prospects.
Right. So at its heart, Oracle's this enterprise IT behemoth, right?
Right.
Cloud software, hardware, all that. And the market cap, it's just staggering. $863.64 billion. So the big question for us today, I think, is how is this huge bet Oracle's making on AI actually reshaping its finances? And, what should you be keeping an eye on as this whole thing plays out?
Okay, so let's just cut straight to it. What was the spark? What got everyone so excited after their Q1 results on September 9th? Because, actually had a slight revenue miss compared to what analysts expected. Normally, you'd think the stock might dip a bit, but nope, it surged. So why? Why did investors get so bullish despite that little miss?
Yeah, that reaction, it really came down to one absolutely massive figure, the remaining performance obligations, or RPO. Think of RPO as like guaranteed future revenue. It's contracts they've signed but haven't booked yet. And this number didn't just grow, it exploded up a staggering 359% year over year to $455 billion.
Wow, 455 billion.
Exactly. And the cloud part of that RPO, up nearly 500%. Management's even saying they expect this backlog, this pipeline, to cross $500 billion soon. So the insight here is just, it's profound, really. They've essentially locked in almost $500 billion in future business. That gives them incredible visibility, signals massive future growth.
And the current cloud numbers are pretty spectacular too, right? Not just the future pipeline.
Oh, definitely. The Q1 numbers themselves were strong. Total revenue, $14.9 billion. That's up 11% year over year. Solid. And total cloud revenue, that's apps and infrastructure, grew 27% to $7.2 billion.
Okay, and digging into that infrastructure piece, OCI.
Right. Oracle Cloud Infrastructure, OCI. That hit $3.3 billion in revenue, soaring 54%. And OCI consumption revenue, what people are actually using, was up 57%. Even better.
But the one that just blew my mind, and I think maybe the markets too, was the multi-cloud database revenue. This is where they put their database tech inside AWS, Azure, GCP.
Yeah.
That grew, I was at 1529%.
15-29%. It's astronomical.
Is that sustainable? What does that crazy number tell us about what customers want?
Well, sustainable at that level? Probably not forever. But that 1,529%, it's a huge signal. It tells us businesses are desperate for flexibility. They want Oracle's database power, but maybe they're already committed to AWS or Azure, Oracle's solving that problem directly. And what's really crucial is how this OCI growth, and especially this multi-cloud success, feeds directly into their big AI ambition. They're landing these multi-billion-dollar deals with the huge AI players, OpenAI, xAI, Meta, NVIDIA, AMD. These aren't small fish. Their commitment to Oracle. It says a lot about Oracle's infrastructure capabilities for these really demanding AI workloads.
Right, it's validation, but it's not all sunshine and massive growth, is it? We saw that legacy software number.
True. Important context. Their legacy software revenue, the oldest stuff, actually dipped by 2% year over year in Q1. So it really underscores this transition. They're actively shifting focus, pivoting away from the old towards these new high-growth areas, especially cloud and AI.
Okay, so this massive push, building data centers, signing AI giants, that obviously costs a fortune, and it's hitting their cash flow, which might, raise some eyebrows. Negative $5.88 billion in free cash flow over the last year, and negative $362 million just in Q1. So for you watching this, how concerning is that? Does the spending put them under real pressure now? Could it backfire?
That's the multi-billion-dollar question, isn't it? And yeah, it's a critical part of the story right now. Oracle sees this negative free cash flow, big as it is, as a strategic choice, a necessary investment. They're planning to spend around $35 billion on CapEx, capital expenditures, for the full fiscal year 2026. That's money for building assets.
$35 billion, that's huge, up from about negative $27 billion TTM.
Exactly. It's a massive ramp up. And it's mostly going into building these enormous gigawatt scale data centers designed specifically for AI, plus all the servers and gear that generate revenue. Why? because, in their words, demand for OCI dramatically outstrips supply.
Yeah.
They're betting that this new capacity will let them quickly turn that giant $455 billion RPO backlog into actual revenue and eventually profit. So, yes, it hurts cash flow now, but it's very deliberately a long-term play to capture what they see as massive future opportunity.
And it seems tied to their unique selling points, their moat, if you will. They're not just building generic cloud capacity like this new AI database they've launched. What's special about that?
It's a really key innovation. It lets companies securely link their own private sensitive enterprise data with powerful public AI models. Think ChatGPT, Gemini, Grok, Llama, which Oracle uniquely hosts within its cloud. So you can ask questions that combine your secret sauce, your private data, with the world's knowledge securely, without that private data ever leaving your control. That's a big deal for enterprises.
Hmm, interesting. And what about this cloud at customer thing, codename Butterfly? That sounds different too.
It is. It tackles data sovereignty head on. Basically, Oracle installs a complete self-contained version of its public cloud inside a customer's own data center. So you get the cloud tech, the features, but your data physically stays on your premises. That's crucial for regulated industries or countries with strict data laws. And the cost claim is pretty wild. They estimate the hardware at around $6 million, which they say is like 1% of what competitors charge for something similar.
1%. That sounds almost too good to be true. Is there a catch? Like maybe it doesn't scale as well or you don't get updates as fast compared to their public cloud?
That's a fair point. There are usually trade-offs with these kinds of on-premise cloud solutions. You might not get the absolute bleeding-edge hardware quite as quickly, or the elasticity might be slightly less than a huge public region. But for the customers targeted by Butterfly, the control, the data sovereignty, and that potential cost saving often outweigh those factors. They value predictability and security for certain workloads.
Okay, that makes sense. And beyond Butterfly, they're still pushing that multi-cloud database strategy hard.
Oh, yeah. Already got 34 of their database regions running inside AWS, Azure, and GCP. Plans to get to 71.
Plus, those performance claims for their big data centers half the cost, if twice as fast, for AI work. Are those claims holding water in the real world?
Well, it's definitely bold marketing, half the cost, twice as fast. But there seems to be substance behind it, especially for AI training and inference. It comes back to their specialized hardware and, how they build their whole stack. And remember, Oracle sees itself as the custodian of the world's most valuable private enterprise data. That's their framing. This gives their AI database, the one linking private and public data securely, a unique edge in their view. The fact that major AI companies are signing multi-billion-dollar deals suggests that Oracle's performance and cost are compelling, at least for these very specific, very demanding AI tasks.
All right, let's pivot to valuation then. The stock last closed at $307.86. It took a bit of a hit that day, down about 4.6%. Context is key. The 52-week range is wide, from about $119 up to near 346 SEK. Trailing PE ratio is up there, around 70. Price to sales around 14.6. So yeah, it's not optically cheap. Which brings us to analysts. Where do they see this going?
And this is where it gets really interesting, because you see a big split, or maybe a rapid shift in thinking. Our own analysis, for example, puts a price target at $240.25. Our fair value estimate back when we reviewed earnings was around $211, when the market had it near $242.
Okay, so quite a bit lower than where it is now.
Right. But contrast that sharply with what happened right after the earnings announcement, around September 10th. With the stock jumping up to the 330s, suddenly you saw a flurry of upgrades. New analyst price targets popping up from $300 all the way to $400. The average target jumped to around $357. So it clearly shows a major divergence of opinion and analysts scrambling to reevaluate Oracle based on that huge RPO number and the whole AI narrative.
That's fascinating, a real tug of war in perception. So, boiling it down, what are the core bull versus bear arguments right now? What's the strongest case for being optimistic?
The bull case is powerful, you have to admit. It's built on that explosive AI-driven cloud growth, backed up by that massive record-breaking RPO. That's future revenue locked in. Then there's this strategic differentiation. The AI database, cloud at customer, the multi-cloud strategy, they're carving out a unique niche. The huge CapEx spend, while a drag now, is seen by bulls as absolutely necessary investment to meet proven demand that's off the charts, building for the future. And they have a very clear long-term target, $144 billion in OCI revenue by FY 2030. A lot of that's already reflected in the RPO.
Okay, sounds compelling. What's the biggest worry for the bulls, though? The crack in the argument.
Is probably the execution risk and the timeline. Can they really build out that capacity fast enough? And how long will it take for that massive capex to actually translate into positive free cash flow? It requires patience and faith in management.
Right. And on the flip side, the bear case. What are the biggest red flags they point to?
Bears definitely focus on that negative free cash flow. It's a big number. And they question the immediate strain on finances and profitability. They also point to the continued decline in legacy software. It's a drag on the overall top line, even if cloud is booming. Valuation is a constant concern. Trading at these levels means high expectations are already baked in. Any slip-up could be punished.
Execution risk again, basically.
Exactly. Plus, the reliance on complex global supply chains to build these data centers introduces risks delays, cost overruns, and, of course, the competition is fierce. Amazon, Microsoft, Google aren't standing still in cloud or AI. Oh, and a minor point maybe, but something to watch, is tax rate variability. Q1 non-GAAP rate was 20.5%, a bit higher than the 19% they guided for. Small bumps matter at this valuation.
Wow. Okay, this has been a really insightful dive into Oracle's massive AI gamble. We've seen this company really transforming, right? Piling up this huge backlog, spending massively to meet it, and trying to build these unique competitive advantages.
Precisely. It's not a slow evolution. This is Oracle making a high-stakes, kind of all-in bet on leading the next wave of AI infrastructure. That RPO figure provides a strong foundation, a lot of confidence, but turning those billions in CapEx into actual profit and cash flow, that's the execution challenge ahead.
So here's a thought for you to ponder. Oracle's got this incredible backlog, demand way bigger than supply right now. How fast can they realistically build out the needed infrastructure? And maybe more importantly, what's the single biggest obstacle they face in turning that huge RPO number into cold, hard profit on the bottom line? Something to chew on. Thank you so much for joining us on this deep dive today. If you found this valuable, if you want to stay ahead of the curve with analysis like this, please do consider subscribing. And hitting that notification bell really helps support us and make sure you don't miss our next exploration. Thanks again, and we'll catch you on the next one.